Hey, Tyler, let's do something a little bit different.
That could go in a lot of different directions or a lot of different ways, Jason. So, why don't you be a little more specific here? Well, I assume you don't want to talk about baseball because it is December.
Well, it's a hot stove season, so we could, but we're not gonna because we don't want people to leave. I've got a fun idea and something you and I've talked about a little bit before over on our podcast that I do with Jeff Santoro. We do a annual reckless prediction show. So here's what I want to do. I want you and I to make a couple of predictions, a prediction each about 2025, the stock market, whether it's individual stocks or the market or something that can affect the market. I want us to make a prediction and explain why. Not because we think we're going to be right, because we're probably not going to be right, maybe directionally kind of in the right way, but because it's a good exercise and it's fun. But then after we do that, have that little bit of fun, let's each talk about an investing idea that we have that we think no matter what happens in 2025, we think investors that by now will still be perfectly happy to have made that investing decision 5 years, 10 years down the road. What do you say?
That sounds a lot more fun than talking about who the Braves are going to sign. So let's do this.
Okay. I actually agree with you wholeheartedly. Before we get into the details, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should go check out our special link. It's fool.com/unscripted. Go check out that link and you can get access to The Fool's 10 best stocks to buy right now. All right, Tyler, you go first here.
Okay. I've been struggling to articulate to this one lately because I find I've been thinking about it for a long time and I think I'm just starting to come around to how I want to say this. I think we're going to have sticky inflation. I think it's going to stick around. It's not going to be the 9% that we saw during the worst of supply chain woes, but I think there seems to be a lot of policy decisions and things that are being ballyhooed around as political priorities lately that do tend to make for inflationary conditions. If you want to talk about things like tariffs, you want to talk about things like reducing labor force through immigration crackdowns. These are inflationary things. Like in I guess you could say economic theory, always in practice things could go a little bit differently. But in theory, these are things that should increase inflation. You're reducing your labor force, you're increasing the prices on imported goods. Those are all inflationary things. And for as we've seen over the towards the end of the year here, we've been slowing down interest rate cuts that or the Fed has been signaling slower interest rate cuts than originally expected. That means that they are still probably thinking about inflation more so than they're thinking about employment. And if that is the case, it's kind of hinting at the idea that inflation may be higher through all, or at least stay remaining higher through 2025.
Thinking about the implications for businesses and stocks that we own. One thing we saw during 2020, 2021, when inflation started to rear its head and get to levels we haven't seen in 40 years, a lot of companies were able to pack in some extra profits during those periods. They were able to pass along the inflation, but also just raise prices above that and become more profitable. It's become a lot harder for that to happen. And I think if we see inflation, particularly if we see inflation that happens because of businesses that are having trouble finding labor because of like mass deportations as an example, that's going to hit companies in the bottom line, right? That's a production side issue. The same potential issue with tariffs, right? If that reduces the flows of goods into the country, it's going to affect revenues. It's harder to pass your operating costs along. So I think you're right. I think there's a bit of a risk. And now that actually ties into my prediction that I want to make. And this is a prediction that most of the time when you make it, you're going to be wrong. But I'm going to predict that we see a 20% stock market bear market in 2025. The number one reason why that's a terrible prediction is because the market goes up 75% of years. Part of the reason I think that this could happen, you and I have talked about valuations before. I'm going to bring up a slide just to share how top heavy the market has become and think about some of the valuations. So the first one you see right here, 27.9 times earnings. That's roughly where the market is right now in terms of the S&P 500. Its valuation, the average is about 27.9. Now, what is this? This is you could almost call it the Magnificent Eight now. This is the 8 companies in the S&P 500 that are the largest market cap that all are above or right around $1 trillion. I think Broadcom's fallen below that in the past few days. But the point is, you take those 8 companies, 7 of the 8 trade in excess of the S&P 500's valuation. The only one that's below that's Alphabet. And actually, that's not too terrible of a price to pay for Alphabet. With Broadcom, the most recent company to break that $1 trillion, that 4 comma club, 180 times earnings. These are very, very expensive stocks, and they're roughly 33, 34% of the market. This is the next 12 companies in the S&P 500 by market cap. So you combine that with the first 8, that's the 20 largest companies by market cap. And again, that, just under 28 times earnings for the S&P 500. You've got 4 companies on this list of that 12 that trade for a discount to the market. Here's the thing. They're Home Depot, which is growing revenue. It's declining right now, but its long-term growth rate at this point is in the low to mid single digits. You have ExxonMobil, the largest oil companies in the world, and one of the largest banks in the world. And then you have Berkshire Hathaway. These are companies that should trade for a discount to the market's valuation for a long term. So I think my first point is that valuations have stretched. And we know they can stay stretched for longer than we might want them to. But the point is that with so many of those companies, with the expectations, that entire first list, that first 8, those are all AI stocks. They're all being driven by expectations for artificial intelligence. At some point, thinking about the Gartner hype cycle, at some point, we're going to enter into the trough of disillusionment where all it's going to take is like one person shouting fire in the theater and it sends everybody for the exit. So I think that is a potential risk to the market in 2025 that could realistically happen. And then you look through the rest of the market and you see a lot of investors have already moved to a perceived safety, like Costco trading for 50 times earnings is an extremely expensive valuation for a wonderful business like Costco, but you're paying so much for its relatively modest growth. I think you put those things together and there's a very real risk that we do see a drawdown, particularly when you tie it into the risks to the economy of things like inflation, labor shortages that could affect it. Those are our predictions. If we get them right, it's mostly going to be because we were lucky, not that we were necessarily good, but there's the case there. But if you're buying stocks, you have to be thinking beyond next month, next quarter, next year. You have to be thinking long term. Give me a stock that you think if investors bought today, no matter what happens next year, they buy it, hold it for the long term, they're going to be super happy.
So this is one I've mentioned a couple times over the last year or so, and it's a Lantheus Holdings. It's a company I kind of unearthed while doing some work in the healthcare space. And this is a company that builds radioactive tracers for things like CAT scans, PET scans, basically a lot of radiological medicine that happens in a hospital, where it kind of is a way of enhancing the images to make them a little bit clearer to read. They came up with a novel radioactive isotope that helps them better diagnose metastasized prostate cancer in patients who may be non-remittent solid tumor prostate cancer. It's been not like a revelation in terms of detecting prostate cancer and metastasized forms of it in the body. And recently this year, the Centers for Medicare and Medicaid Services gave the approval that this particular kind of, we'll call it diagnostic tool, it is now paid for separately from the actual scan itself. So it's a way of generating considerably more revenue from the product. It's a healthcare diagnostic, and it's not exactly something that people tend to put off. If you need to get a PET scan to make sure that your prostate cancer is in remission, it's not
You're not too concerned about what the rate of inflation is when that's going on.
Exactly. So you have that, and then they have some interesting development pipeline things on top of this diagnostic tool. They're actually looking at radiotherapeutics, so using the radioactive isotope to deliver medicine or a therapeutic to the isolated area as kind of a hyper-targeted cancer drug. And also they're starting to look at some very interesting radioactive isotopes to better assess Alzheimer's in patients, and they have several phase 2-3 trials that are getting fast-tracked. So there's some really interesting pipeline, and their current offering is quite a cash generator. I think over the past couple of years, their revenue has grown, I think 5x in the past few years once this drug actually got approved, or this diagnostic tool got approved. So I think there's a lot of interesting things going on, and at 15 times earnings and throwing off a lot of cash from this novel drug, I think it's a pretty interesting company for the long term.
Yeah, I like the idea of healthcare. Spend continues to flow that way as we get older. And as you've talked about on other video, if you're interested in this company, guys, go back and look in our channel and just search for Lantheus. We've covered it a couple of times, and there's an interesting story there that could really be massively, as much as this has already been a winning stock, it could really pay off. I'm going to immediately pivot to a stock that's heavily tied to AI, is the stock that I'm going to pitch after just saying that AI could be the reason why we see a 25% drawdown in the stock market this year. Tyler, I'm going to make a pitch for Synopsis. So for people that don't know, Synopsis is a software company. They do EDA, electronic design automation. So when you're making a semiconductor, there's a lot of automation that software does now to iterate your design. And Synopsis is one of 3 companies that have the vast majority of the share globally of EDA software. And they're one of the 2 that have the largest share of the market, along with Cadence Design. So the thing that is appealing to me about Synopsis right now is that because of concerns with the semiconductor industry, because of concerns with China and the US and the potential trade war that's brewing there, because a lot of semiconductor design happens in China, there's definitely some risk in the near term to Synopsis business. But again, thinking long term, I think there's a tremendous amount of really strong potential because the company is so strong in the semiconductor industry. Things like the electrification of everything, automated transportation, artificial intelligence writ large, more companies wanting to design their own silicon for purpose-built sorts of applications. It's really important and growing, this spin. So I think Synopsis is going to continue to take share. They also have a pending acquisition of a company called Ansys that they partner with, that they're once this deal closes and they start integrating these 2 businesses together, it's going to be a really powerful match. This is not one of those big transformative kind of acquisitions that we get all these promises and then they just wash out all of the value. There's a tremendous amount to like about bringing these 2 businesses that are really strong separately that will make them even potentially stronger together. So I think that acquisition, that merger would create a lot of value and make it even stronger. Because again, they do so many things where their users are using both products already. It makes a lot of sense to integrate. So you combine those things and the concerns with the business right now. This is a stock that spent most of the past 5 years trading above 50 times earnings, trades for about 34 times earnings right now. So again, that's above the market premium. This is a software company. They trade for higher multiples than the market on average, the same way that banks trade for lower multiples because of the economics of their business. I think Synopsis is worth buying right now. We might get a chance to buy more of it next year at an even better price if we see some further deterioration of the economy. But I think paying today's price and you hold this business for multiple years, 3, 5, 10 years down the road, I think you continue to see market beating results from owning it.